Hey, it's JJ Conway. Welcome to the Ladies of Wealth podcast, where we help hardworking women and a few good men dump debt, build wealth, and prosper. It's Juice with JJ, where I keep you informed about scams, financial controversies, and money shenanigans so you can keep your cash flow funding your dreams and out of their pockets. Let's get into it. Hello, everybody. I'm so excited to be with you today. I know I've been kind of dragging the last couple of days, got a lot of family things to deal with, a home going, and some other issues with different family members here and there and everywhere. And it's just a lot, but I'm excited to be able to be with you all today. I'm explaining all that because I've been definitely feeling it in my physical body. You know, there's a book I'm working through called The Body Keeps the Score. And one of the things that it talks about is how if we don't deal with trauma, it can seep deeply in our body and surface later as medical conditions. And I'm not even thinking about the long-term trauma. I'm just thinking about the last couple of weeks and how I already feel it. I mean, I literally was trying to train my new intern yesterday, and I would hover in mid-click and fall asleep. I said, okay, we're not messing around anymore. I'm getting all the sleep. If you've got a money question, it can be any money question about business, about your personal finance, about sending kids to college, about how to make more money at work, how to be more valuable at work, all those kinds of things. That's what this space is for. Somebody asked me about insurance because there was a thing that I said either last week or the week before, how I'm not a big fan of whole life insurance policies for most people's situation, but there are some situations where I think a non-term, like a whole life or variable life or some of these other universal life, so these other products might be applicable. And I admit I admit I may not have been the nicest in some of my comments on that. It might have been during the Juneteenth thing. I don't remember. I will admit I may not have been the nicest in some of my comments because I honestly find that most of the people who are selling the high-end insurance products, that they're selling it as a wealth building vehicle for the lower classes to ascend to higher classes. But the only person ascending to a higher class from the use of those products, in my experience, and your mileage may vary, is somebody who sells those products. So if you are somebody who didn't sell those products, does not have a family member who sells those products, and you would like to give me some examples in your life of how those products have helped elevate you, I'm certainly open to hear it. But for most of the people that come to me, they have a net worth of 2 million or less. They really don't need anything beyond term insurance for their family situations. And the reason I say that is because there's two situations where I highly recommend you consider those kinds of products. One is when you have a very high net worth, because if you're worth, if you're worth 20, 25, 35 million dollars and you come to me with, well, not me, because I'm not licensed to take your money, but you come to somebody I recommend with $1 million, they can take an insurance product and turn that $1 million to 7 million just like that. You're gonna have to pay a few extra penalties and taxes and things like that other people wouldn't pay. But boom, you just converted that money. And I am also cognizant of the fact that as we get older, it's hard to get term insurance. In fact, I have a policy that's $750,000, and it was a 30-year policy that I took out for my oldest to get him through college. If something happens to me before he finishes college, that money is there to help him get a good footing. Well, when the second miracle baby came along 10 years later, I went to try and get insurance, and y'all, it was like $1,000 a month at first. And then COVID happened and the rates dropped. And I was like, jump on that. And I ended up getting a 20-year policy that should carry him through college by the time I got it. I think he was already 4 or 5 or 6 years old. And at that time, the product that I have for my oldest is $300 a year. The product that I have for my youngest is $70 a month. And that is with some significant health challenges. But I mean, originally when I tried to do that and it was like $1,000 a month, I was like, well,
before I pay $1,000 a month for insurance, I'm gonna invest $1,000 a month. And if you've ever done some calculations, you don't have to take my word for it. Go into Google, look up retirement calculator, look at what it would happen if you put $1,000 a month into the market, say in your self-directed IRA, where the money is tax-free if used for retirement purposes, or the money can grow tax-free for your heirs, right? If you put that in there and you chart out what happens when you put $1,000 a month in for 20 years, you're going to realize you don't need to pay $1,000 a month for 20 years. Now, I will say that's a little bit artificial, because if something happens to me, my husband will take care of the little one. All right. But if you are a struggling single mom, if you are a struggling single dad, the last thing I want you to do is to be spending $500 a month on a $200,000 insurance policy. You could take that $500 a month and you could save that every month for a year, and your children will have enough money to bear you. Now, it won't be the most fancy thing. You probably need a couple years for that, but they'll have enough to bear you. And if you have more money, you can set more aside and they'll have enough to bear you. Okay. And so I don't really like, I don't know why I keep talking about that. Maybe because my auntie's funeral, her visitation is tomorrow and the homegoing is soon. And I remember what it was like when my father passed away. He didn't have enough money or insurance or any other products to cover his burial, right? And you say, well, what about if I have younger kids? This is why I feel like it's very essential to get that term policy, because you want to have some kind of coverage. All right. But the reality is, if you're spending $500 on one of those bigger products, chances are your equivalent cost for that equivalent amount of insurance on a term might be 30, 40, 50, $60 a month instead of 500. Do you see what I'm doing? I'm not saying those products aren't valuable in the right time and place, because, I can't wait till I get to, well, actually, I'm not going to do that because I'm going to just keep buying real estate. But I was about to say, I can't wait till I get to the point where it makes sense for me to buy one of those products, right? And I hope the other case I'm about to tell you about never happens to me. I'm going to be point blank about that. I hope the other case I'm about to tell you about never happens to me. All right. But if it does, that's another situation. But the difference is the extra money. The reason these other policies are so appealing is because they take the extra money that you pay them and they invest it. But the thing is, you might be able to borrow against those investments and those cash values, but they're not yours. And the money you put in the market, the money you put into your self-directed IRA, self-directed IRA, if you're in your 20s, you're like, I don't want to put my money into something I can't pull out for 5 years, for 50 years. Well, okay, I get that, but it grows if you do it right. It grows. I keep saying self-directed IRA. I'm sorry, y'all. I don't mean that. I don't want you to put money in a self-directed IRA unless you know what you're doing and you're going to make something happen, because you're going to be like me, like the first 3 years it made no money. And then the company's going to be like, yeah, it made no money because you didn't do anything. It's called self-directed for a reason. That means you have to direct the investment, and you didn't do squat. You were used to the IRAs where you put money in, and somebody else does the investment for you. That's not self-directed. That's a mutual fund. That's an index fund. That's some kind of fundity fund. Okay. It's not a self-directed IRA. So I was saying the wrong thing, and I'm going to have to make sure we cut that out because we're getting ready to start the podcast back up. But what I mean to say is you can put it in your Roth IRA. Okay. Your Roth IRA is going to be the one that grows tax-free. So if you heard me saying that, I'm sure some people dropped off like, this financial planner, I don't know what she's talking about. Count it in my head, not my heart. All right. But when you're young, you don't think about, I want to do that. Okay. When you're young, you don't think about, oh, I'm going to invest something. But this is the kind of reason why we start all this while we're young. This is the kind of reason why we start and get insurance while we're young and healthy. So we can get the insurance that's $750,000 coverage when it only costs us $300 a year. Okay. We don't wait until we're in our 40s with sleep apnea and this damage and that damage and this disease and that disease, or our 50s or our 60s, and then it's $1,000 a month. Okay. We do do these things when we're young. We put those policies in place when we're young. We put the sound financial principles in place when we're young. We start investing in the self. Nope. Almost did it again. In the Roth IRA or other retirement vehicles when we're young, so that money can be working for us in the background the whole time. And then when we get there and we need it and we're too broken, or we have other issues, or we have other time constraints, or fill in the blank of whatever it is that's keeping people my age and older from saving, when all that life happens, you got it. Okay. So I hope I've explained that part a little very well for you. Now that I corrected my terminology, the other case, and this one's kind of hard to talk about because I have found a friend and I, when I was in Maryland, I thought my oldest was autistic. He's not autistic, but I thought he was because he exhibited a lot of autistic um, tendencies. And so I started doing a whole lot of research, and I found out that some counties in Maryland had good support services, like Montgomery County, and other counties didn't have good resources, such as Prince George's County. And so a couple friends and I got together and we created MarylandAutism.org. And the whole point of MarylandAutism.org was to be a clearinghouse for information. Here's some state benefits that you can access. Here's some county benefits that you can access. We went through all those things. Okay. I learned about the world of having a disability and being on what is it called? SS something. The disability money that they give you, that the state will give you, the different things that you can get from the federal. We learned about all those things. And one of the things that I learned in that is that when it comes to a special needs child, now, I'm not saying that my son at the time had a prognosis that he would need those. I thought I was learning about this. I thought he was going to fit that gap. I was learning more to make sure I could be a good mom to him. All right. He turned out not to be autistic. He turned out not to need these things. But if he had, one of the things I would have had to worry about as a parent is if he made too much money, he could lose his disability. He could lose his benefits. And so there are certain things called special needs trusts that you can set up to provide funding that helps provide the care and the nurturing and the things that your special needs child needs when you are no longer here. The thing about a special needs trust is it's got to be funded somehow. And if you don't have any significant savings, so if you don't have, $2 or $3 million in assets and other things that can be used to fund the trust upon your death, well then you might actually be a good case model for one of these enduring lifetime insurance products, because you don't want to do like I'm doing, where I've got that thing set. Like, if that boy piddles around and doesn't graduate on time, and he takes 2 extra years, the money won't be there for him if his mama passes away. All right. Because I calculated it out. I gave him 2 extra years in case he went back to get his master's. Right. But after that, he need to be a man and stand on his own 2 feet. All right. But if he had turned out to be autistic, I wouldn't want my insurance to cut off after 30 years, after 25 years, or whatever it was I bought it for. I think it's 25 years now. I wouldn't want that because I'm going to need it to be enduring. I'm going to need it to last if I'm 70 or 80. I'm working hard to take good care of myself. Little one poked me in the eye the other day talking about, are you really going to be here till I'm 90? Till I'm 50? Yeah, that means you have to live till 90, Mom. And I don't think you're going to live there. And I was like, first I was offended. And then I was like, well, honey, that's why I work out all the time, because I'm trying to make sure I can be here till you're 50 at least. And that child. But the thing is I wouldn't want that to cut off. Right. So we have to understand that there are some valid use cases. But I'm going to tell you right now, you go to this thing in the middle of a hotel ballroom, and they start talking about how you can have tax-free loans, and you can do all these different things tax-free, and it's a borrow against this and a borrow against that. I want you to sit back for a second, go back home. They usually don't let you go back home. They want you to sign on the dotted line right away. Go back home, do the calculations. And if you have the money to afford those products, then look at what it would cost if you did term and invested the rest. If you did term and then invested the rest, you invested it in mutual funds, index funds, real estate, other things that are going to grow in the assets. And then when you pass away and you have $1.5 million in investment assets, your heirs actually get $1.5 million in investment assets. With the other guys, you buy a $500,000 policy, they take $100 of that $500 a month that you're paying, they put it towards term insurance or whatever insurance for you, right? They put that towards insurance for you because that's what it costs at that time. Or maybe it's like 50, but it grows over time, so they balance that out. They got actuarial tables. They figure out how they're not going to lose money on you, right? But when you start one of those policies, whatever they're charging you, the bulk of that is going towards investments. But guess who's getting that investment? That investment could grow to the same 1.5 million. It could grow to 2 million. It could grow to 5 million. But guess what? Your heirs are getting 500,000. So I'm not saying those products aren't ever worthwhile, but if you can't afford to buy your next car in cash, don't come talking to me about those products because they're not making you rich like you think they are. Okay.
Hey, y'all. Hey, don't forget to like, subscribe, and forward the podcast. To ask your question, submit online at askjjc.com or leave a voicemail at 1-833-4-ASK-JJC. Hey, and don't forget to go to ladiesofwealth.com. You can download past episodes and take our free class of the month. Now go walk in abundance and leave a legacy.